So we'll start from this problem. So this problem deals with flexible budgeting. We'll read the question required. So the required is, using a flexed budgeting approach, redraft the operating statement so as to provide a more realistic indication of variances. Explain why the original operating statement was of little use to the management. So they have given us some data and we have to redraft it in terms of flexible budgeting, and we have to work out. So we have already seen in the theory video that flexible budgeting refers to conversion of the budget units into actual units terms, but the amount per unit should be in terms of the budget. So we have to work out this problem and see how flexible budgeting works. So as usual, we'll start from particulars. So we have to find out the flexible budget, the actual, and also the budget. So we'll start from units, sales, then in terms of then cost of sales, that's split into variable cost and fixed cost. We'll get gross profit. So we don't need to work out in gross profit terms because that again goes to kind of financial accounting terms. What we'll do is we can work out in terms of marginal costing statement. So what we could do is, first we can have all the variable cost. Then we can have the fixed costs. I think that would work well. So then we have selling and distribution cost, selling and distribution cost. So again, that's going to be variable. We also have a fixed element in that. Then we have admin cost. So I think we have got all the cost here. So how does this work? So first we'll get the units, 640, then 720 here. So what would be the flexible budget units? The flexible would be similar to the actual because we have to compare these two only. So let's get the sales, 1024, 440, then 100 here. So selling fixed is 72 and administration is 184. Selling and distribution variable is 144. And administration cost variable is 48. So we got all the numbers here. So we'll also get fit for the actual because we have to compare it. 1071 is the actual sales. Cost of sales variable is 468. Selling and distribution variable is 153. Administration variable is 54. Fixed cost of sales is 94. Selling and distribution fixed is 83. Administration cost fixed is 176. So now we have to get the flexible numbers. So how do we work out the flexible numbers? We have to do calculation. So we'll do the calculation here itself. We don't need to do in a separate place. So to do a calculation, it works like this. It's going to be sales amount is 1024, but this is even for 640 units. But we want it for 730 units, right? So that's what we want. So rather than putting it as 1024, we can get this number. So divided by 640 into 730. Let's get the number. So this is how it works. So the same concept, we just copy it and we paste it for all the variables. So it would be 440 here, 144 here, and 48 here. You can copy all of them. So for 640 units, it was 440. For 720 units, it should be 501. The same logic applies for all the other numbers here as well. And if you take fixed cost will not change. It will be the same number. So we can just directly put it here. We can get the contribution. Okay, so we can get the contribution. The contribution would be the sales number minus all these numbers. So it's 447. So again, what would be the profit? The profit would be this number minus okay, so profit is 91.25. That it should have been 91.25. So let's get the answer for the actual. The contribution should have been 396. It should have been 447, and profit should have been 91, but it's only 43. So where is the problem hiding? So that is what we have to find. See, the problem is in terms of the variance. So variance is the difference. See, should have been this number, but it is this number. So 97 sales is lower, and in terms of cost of sales, it should have been this number, but it is a lower number, so that is good. Okay, so we can work out for almost all. See, the variance occurs because of the fall in sales. Okay, sales should have been 1168, but it is only 1071. So because of that only the variance is like incurred. Okay, so this is a negative number. So if you add all the variances, not all, okay, at least these variances, you will get the total. So that's 48.125. So that's about the sum here. The concept is we have to find out this should have been, okay, the sales should have been this number, it is this number. The cost should have been this number, but it is this number. Okay, so in terms of sales, actual should be higher. In terms of cost, the cost should be lower, okay, than the budget, the flexed budget. Okay, so that's why we have changed the numbers, like actual minus budget or budget minus actual. We have changed and worked out. But however you work out, you can get the logic of it perfectly. Ensure that you understand the logic of it so that you can get the answer perfectly. Okay, and if you want, you can mark it like this. This is adverse, this is favorable, 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 again favorable, favorable. This one is adverse, and this is adverse. Okay, so that's about the problem here. Hope you guys got a good understanding about flexible budgeting. We'll move on to the next sum. So here we have a sum. This sum is also about flexible budgeting. We have some data, but before doing the data, first we'll start from the required. The required is explain why budget variances should be calculated using flexed budget figures. Okay, so why should we do that? Because we have to compare the uh, actual activity with the budget. Okay, so budget is usually a fixed one, so we have to get a flexed activity to compare. Then we do prepare a flexed budget for the appliances division for November and recalculate the budget variances. So for November or for appliance division, we have to recalculate the budget variances. Okay, so we'll read the question and see like what is given. So Francis is a manufacturing company. It assesses managerial performance by comparing actual with budgeted results. Due to staff shortage in the accounting department, figures for November budget reports have been prepared by a trainee. A copy of the budget report for November for the appliances division is given below. So he has given us sales and production volumes and units, sales, direct material, direct labor, manufacturing cost, and other fixed overheads. He has already worked out budget and actual. He also has variances here. So let's look at the points that have been given here. So the manager of the appliances division does not believe that the variances calculated give a fair assessment of her division's performance. She thinks that the budget figures are inappropriate and that a flexed budget should be used to calculate the variances. To assist in preparing a flexed budget, she provides the following information. So these are the following information. Selling price, budgeted selling price per unit is 200 and actual selling price was 196. Direct material is a variable cost and budgeted direct labor cost for a fixed element of 50,000 per month. The balance amount is a variable amount they have indicated. Other manufacturing costs are semi-variable. So there is something called as other manufacturing costs. Budgeted cost and output for the 2 months were as follows. Okay, the previous months I think data he has given. So 4,000 is output and 210 is the cost. 3,000 is the output and 170 is the cost. There is known to be a step up of 50,000 in the fixed element of this cost for volumes in excess of 4,500 units. So if the number of units is going to go up by up to 4,500 or beyond 4,500, the step up cost would be 50,000 additional. So that's about the problem here. So let's work out the problem. So budgeted, flexible budget, actual, so this sum has to be worked out in a lot of working notes. So let's start. So sales, material, labor, manufacturing cost and divisional fixed overhead, and finally they get profit. So we have to divide these elements in terms of variable and fixed. If possible we can split it, or we can also show it like as it is. So let's see how we could work it out. So we'll start from the budgeted sales number. I think first we'll type the actual because that is the most easiest. Whenever you get a sum, you have to ensure that you do the easiest things first, or just understand the easier things first, so that the balance could be done later also. Okay, I think we got all the actual numbers. So let's wait. We'll work out the sum in terms of thousands. So let's get the sales number. Okay, so sales would be the budgeted selling price is 200, but it was sold at 196. That means 1078 has a actual price of 196, but it should have been sold at 200. So what is the answer? The answer we have to find it out. So 1100. So 1100 should have been the sales. So this is working note number 1. So direct material is a variable cost. So however so material we have to find out. So material would be variable. So if you see here, material has a relationship of 25% to the total cost, right? So percentage of material cost to sales, because there's no other way to find it out, or else you can find out through number of units, like that also you can find out, but that seems like very lengthy. So we can relate direct material with the sales. Okay, so we'll do that. So 250 of material is for 1000 sales. So for 100%, what it would be? It would be 25%. So let's work out and see. This is 25%. Okay. So percentage of material cost to sales is 25%. So if our total sales is going to be, should have been 1100, then 25% of that should be, I think that's 25%, should be 275. So we again got from working note 2 that it should be 275. So let's get labor. So labor, they tell budgeted labor cost has a fixed element of 50,000. The balance is variable. So we'll work out that too. So total labor cost is going to be 150. Out of 150, we have to less the fixed element. So the fixed element is 50. The balance is variable. So the variable cost of balance is 100. So now we have to work out again like this. Percentage of labor cost to sales. So it's going to be 100 divided by 1000 into 100. So that will come to 10%. Okay. So what would be the labor cost? So labor cost should be these two elements. We'll work it out. Okay, I think they have given us the units. I think I've missed it. Okay, units is 5000 and 5500. Okay, so but either way we have started working out, we will work it out. $50, variable cost is won't be 100, it will be 10% of 1100 into 10%. So I think that would be 110. Okay, 110. So the total labor cost would be 160. So this 160 you can take it and you can put it here. So labor cost is 160. So we have got up to labor cost. We still have other manufacturing. Other manufacturing costs are semi-variable and they are aligned in this kind of a setup. So we have to work out working note number 4. So other manufacturing overheads. Okay, other manufacturing costs. See, this has two elements here. So first we have to work out the uh, high-low method for semi-variable cost. So how do you work out high-low method? So the first one is variable cost per unit equals to high cost minus low cost divided by okay, so we'll work out this. The high cost is 210 minus 170 and the high units is 4000 minus 3000. Okay, so this is given in terms of 3 zeros, so we'll put all the 3 zeros. So this is in terms of dollar. So we got the per unit amount. So we have to find out what's the fixed cost. So total cost equals to fixed cost plus variable cost per unit into number of units. So we'll substitute this in some number. Okay, any of the parity we'll substitute in October. So in October the total cost is 2,10,000, which is equal to fixed cost we don't know, but we know the variable cost per unit, which is 40, and the number of units is 4000. So 2,10,000 minus 1,60,000. So fixed cost is 50,000. Okay. So now we can find out what is the total cost for, should be the total cost for the 5,500 units. 5,500 units. So we can work out that. So total cost equal to, I think we can just copy the formula here so that you'll get a better idea. So fixed cost is going to be 50,000 plus, see, they have also told that whenever the number of units crosses 4,500 units, there will be an additional 50,000 of step up fixed cost. So that is another 50. The variable cost per unit is 40, and the number of units produced by the company is, for 5,500 we are trying to find out. So what is the answer? So 3,20,000. So 3,20,000 means we can cut the 3 zeros, so it will be 320. So this is working note number 4. So divisional fixed cost, I think it's a fixed element. So let's see what they have told. They have not told anything about that. So usually fixed costs are fixed only. They don't usually change. So 200 will be the same 200. Okay. So that's about the concept here. Now we can find out the profit. I think we can just copy from here. So the profit should have been 145 for this many units. Units budget is 5,000. Flexible budget is, we are doing it for 5,500 units, and actual is also 5,500 units. So let's get the differences here. The sales should have been 1,100, but it is only 1,078. So that is a bad thing. So we should get a negative number. Okay, that's a bad thing. See all the other. So there's also one profit element. So this profit should have been 145. It's only 118. So that's a difference of 27. For costs, it should have been 275 and it has been 286. Again, that's a bad thing. Bad. And finally, this is also, that alone is a good one. So when you totally add all the variance, that comes to 27. So this is adverse, this is favorable, adverse, favorable, and adverse. Okay. So when compared to this, we could see here the number of units sold. Okay, the number of units, I think this is variance. This is variance, and this is the result. So the variance here is 500 units. They should have sold, additionally they have sold 500. That is actually a good thing, but thereafter there's no good things. So if you see the revenue here, it was favorable. See, when compared to the budget, it was favorable because budget they had to sell only 5,000. Here they have sold 5,500. But the logic here is they have sold it at a discount, and material price has gone up, and labor they have paid more. Manufacturing overhead they have like slightly they have lowered it. Divisional overheads they have lowered it, and profit, it's overall it is a bad thing. Okay, so that's about the concept here. Hope you got an idea. You could work out in this manner in terms of these percentages like that. You could also work out in a different manner. If you want, I can put it here, the alternative working. So I'll put a heading called as alternative working, where you can use units and work out. So sales should have been how much? Sales should have been see, 1000 sales is for 5000 units. Then what should have been the selling price for 5500 units? So we'll find out here. It will be the same answer, but little bit short. Okay, it will be little bit shorter. Material, what should have been the amount? Okay, material, the I think we can copy it from here itself. Material amount is 250. So 250 is for 5000 units. What is for 5500 units? We can work out here. We can quickly get the answer. Okay, 275. See, labor also we can work out in the same way. See, total labor cost is 150, right? 50 is fixed. The 100 is variable. So this is for 5000 units. Then what has to be for 5500 units? We have to find out. It should be 110. So 110, okay, plus 50 plus the 50, we will get the 160. So I think that's how we found it. So I think it is here. So 50 plus 110 will give you 160. Okay. So with units, it's quite easy to find out. But what I have done is I have done it through percentage. Okay, both are right. But units, if you work out, it would be quite easy. Okay. So that's about the concept here. Hope you got an understanding. So this sum is quite complex, even though it looks like very simple. Okay, even though it looks very simple, it's quite complex sum only here. Okay, hope you got the idea. Okay, so we'll move on to the next sum.